The Federal Reserve Bank is officially starting to pivot. Jerome Powell has just taken his foot off of the interest rate accelerator with the first interest rate pause in 15 months, and this comes at a time where inflation is still running hot. Now, the interesting thing about the Federal Reserve Bank's latest move was that Jerome Powell still said that you need to be prepared for more rate hikes in the future. Now, you naturally are probably wondering, well, why are you telling us to be prepared for the future instead of just giving us the rate hikes right now? Well, this is what Jerome Powell had to say. He said, holding the target range, meaning the federal funds rate steady at this meeting, allows the committee to assess additional information and its implications for monetary policy. In other words, he says that he wants more time to take a look at where inflation is going, and based off of where he thinks inflation is going in the next meetings, they then will make the decision of how much more they want to continue raising interest rates. Now, the thing that I want you to understand here in inflation is that there are two main numbers in inflation that people like to pay attention to. Number one is CPI, and number two is core inflation. CPI is the headline inflation number that the media loves talking about. This is that inflation number that everyone keeps saying when you hear that inflation has fallen so significantly. The second is core inflation. Core inflation is the CPI numbers, and then you strip out what's called, quote unquote, the volatile numbers, which are things like energy and food. This core inflation is what the Federal Reserve Bank prefers to look at to measure inflation. This is what they've been saying for years, that they prefer measuring inflation with core inflation because it gives them a better gauge on what inflation is. Now let's take a look at inflation versus core inflation numbers over the last few years. This data and this chart is from the Federal Reserve Bank, and the red number, this red line, is core inflation, and the blue line is CPI. And what you'll see is that we saw this peak in CPI back in June of 2022 when we saw CPI hitting right around 9%. And then ever since that peak, we've been seeing CPI fall rather drastically. Now, if you look at core inflation has been kind of not really dropping that much. Core inflation peaked at right around 6.5%. But then after that 6.5% peak or 6.6% peak, core inflation has fallen to the low 5% inflations. So yes, inflation has fallen. CPI has fallen pretty drastically. It's still very far away from its 2% goal, but core inflation, which is the core measure that the Federal Reserve Bank likes to look at to measure inflation, is still significantly high, and it hasn't really fallen that much off its peaks. We went from the mid-6s to the low 5%, which means we still have a long way to go to really bring it down to 2%. And this is where the Federal Reserve Bank is looking at all the data. They're seeing the same inflation data that you and I are looking at. And then they're also looking at the economic data, and they're seeing that the economy is slowing. The economy is slowing faster than expected. And they're saying maybe these interest rate hikes that we've been doing are starting to really hurt the economy. And hopefully the interest rate hikes are going to have more of a delayed effect on inflation. Because what they don't want to do is they don't want to break the economy in order to fix inflation. What they hope will happen is that they will be able to raise interest rates to a certain level, which now they're saying is going to be around the mid 5%. They're going to be able to raise interest rates to a certain level, and this higher interest rates will bring inflation down, and it's going to bring the economy down slowly, but not cause any significant recession or any real recession at all. This is what the Federal Reserve Bank is hoping for. But the risk that they're taking is if we don't stay aggressive on inflation, well, a couple things can happen. You know, you heard the saying that when you try to make everybody happy, you end up making nobody happy. And right now what they're trying to do is they're trying to make inflation happy, and they're trying to keep the economy happy because they want to slowly bring inflation down without overly hurting the economy. Well, the risk with that is, well, you can make nobody happy, because now if inflation doesn't start falling quickly and the economy continues to slow, well, then that could force the Federal Reserve Bank to then have to take even more aggressive action on inflation, which would then hurt the economy even more. And this is where now the question is, what will the Federal Reserve Bank do, and what are they going to prioritize more, inflation or the economy? And this is the big question. This was the question that we posed back in 2020. We talked about it in 2021. We talked about it in 2022. And now we're really starting to see the implications of this in 2023. What is the Fed going to prioritize, inflation or the economy? Because if we see the economy start to hurt, how do you stimulate the economy? Well, you can cut interest rates and you can print money. Well, yeah, that can pump more money into the economy. That can get more people buying things, which can help boost the economy, but that's going to hurt inflation. Right? If the Fed started to cut interest rates, if mortgage rates went down to 4% tomorrow, you're going to see a boom in the housing market. Home prices are going to go up, which would cause inflation to then go up again. So yeah, if we start to see more pain in the economy, but inflation is not fixed and the Fed starts cutting interest rates, that's going to make the inflation problem first and put a Band-Aid on the economy. If the alternative happens where the Fed says, okay, the economy is hurting, but we're going to stay focused on inflation, that means that the Fed would then continue raising interest rates even though you're seeing pain in the economy, and that's going to hurt the economy even more because higher interest rates mean, well, your mortgage rates are even more expensive. Less people are going to buy homes. Less people are going to buy cars. Less people are going to be shopping, which means the economy is going to hurt even more at the expense of trying to bring inflation down. And the reason why this is so significant is because, well, we know how to fix an economic recession. We have seen a recession pretty much every decade for the last century. Recessions are a part of our economy. When you see a recession, we can stimulate, we can cut interest rates, we can do quantitative easing. We have done that many, many, many times. And we've seen that boost the economy. And now we're facing the consequence of that, which is inflation. Now, unlike previous recessions, we're going into an economic slowdown with high inflation already being an issue. Right, when the 2008 crash happened, when the 2020 pandemic happened, when the 2000 dot-com bubble burst, we didn't have an inflation issue going into the recession. We just had the economic issue, which then the Federal Reserve Bank fixed with more inflation. Now, we didn't have an inflation issue after any one of these recessions until now. After the 2020 pandemic, we are now facing the inflationary issue. So now, if we go into more economic pain with inflation already there, how do you fix it? And this is where now, again, it goes back to what is the Fed going to prioritize? And this is that tough question where what are they going to pick, inflation or the economy? Now, again, we know how to fix the economic issues, but the inflationary issues are less certain. And the inflationary issues are also a lot more painful. Because if you face high inflation for a long time, well, that hurts everybody, right? Inflation makes consumption more expensive. And the majority of America are only consumers. The majority of America are not investors or business owners. Meaning, when you have inflation, the cost of buying things goes up. And people's ability to buy things goes down. So high inflation hurts the average person's ability to spend, it hurts the average person's ability to live life, and it hurts the average person's ability to build wealth because now you got to pay more money for your rent and your groceries, so you have less money to invest. That's what inflation does. And so when you have high inflation for a long time, not only do you hurt the average person's ability to build wealth and spend, but you're also hurting the valuation and the currency value. And that can pose even more issues. And so currency issues, high inflationary issues can become significantly painful, much more painful than a recession. And this is where it goes back to the question, what is the Federal Reserve Bank going to prioritize? Is it going to be inflation or is it going to be a recession? Recessions are sometimes necessary to reset the economy. Nobody wants to admit this, but the reality is recessions are sometimes necessary to cool down an overheated economy. And we're living in a society right now where people want to avoid any type of pain, right? We want to desensitize ourselves from any sort of pain, but the reality is sometimes you need economic pain to reset and cool off and get the dumb investments and the dumb businesses out. Yes, that comes at a price because when dumb businesses fail, the employees who worked at this company that was run by somebody bad will unfortunately lose their jobs. That's not fun. That's painful. But you can't let anything go up forever. We've done multiple deep dives on this in Market Briefs, which is my free financial newsletter, which is why if you haven't joined Market Briefs yet, I highly recommend you do so because it's an easy and free way for you to stay up to date on what's happening in things like the economy, the housing market, the stock market, crypto, and the global economy. It's a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. But this is where now you have to kind of look at all the factors. The Federal Reserve Bank has already started pivoting. They just did their first rate pause because they don't want to break the economy and they want to hope and see where inflation is going. Jerome Powell said openly that you need to expect more interest rate hikes in the future. But why not do it now? If the interest rate hikes are important to bring inflation down, why not do that now? You know you're going to do it in the future. You said you want to do it in the future. Why not do it now? It is to see what direction inflation is going. And the goal for the Federal Reserve Bank is not to keep hiking interest rates because that's going to keep hurting the economy. But they don't want to hurt the economy while they bring inflation down if they don't have to. And this is where, again, you have to pay close attention to what the Federal Reserve Bank is doing because these are going to be critical decisions. Because over the next 24 months, we're going to see a huge amount of debt readjust at the higher interest rates. And if interest rates continue to stay high, or if they go higher, well, that means that corporations and commercial landlords and our government, which is holding on to large pieces of adjustable rate debt, as that debt readjusts, your payments, your debt servicing costs are going to go up, not because the amount of debt that you have went up, but because the cost of owning that debt goes up. See, most corporate debt, most commercial landlord debt, and most of our national debt is not 30-year fixed rate mortgages. It's readjusting debt. And we're going to see a huge chunk of our debt here in the United States readjust in the coming 24 months. This is why you, as a financially educated person, number one, need to understand this. And then number two, prepare and be financially educated. Prepare means, one, spend less, earn more. Don't use 2023 as a year to finance a brand new truck. Use this as a year to get financially smart. That way you can have extra cash put aside to protect you, and then also capitalize on opportunities that might come your way, but then also build your financial education. Learn about how do you capitalize on opportunities. How do you invest? Is it the stock market? Is it real estate? Is it building your own business? Is it buying other businesses? Learn about this. And everyone say, well, how do I learn? Start watching YouTube videos. Once you start watching YouTube videos, then start reading books. There are so many pieces of information out there. Yeah, you're not going to learn this in school, but there are so many different pieces of information out there that you just have to start learning and putting yourself out there, and then you got to start doing. You cannot bypass that experience. But this is where understanding what's happening. Interest rates are a lot higher than where they used to be. Inflation is still pretty high. Yeah, CPI is coming down, but it's still not at 2%, and core inflation is still really high. The economy is slowing down. The Fed says that they want to raise interest rates. Will they? Who knows? Even if they start cutting interest rates, well, then that's going to make the inflation problem worse. Who does inflation benefit? Well, it disproportionately benefits investors. This is what you got to pay attention to. If they stay aggressive on inflation, that's going to hurt the economy, and that's going to create more opportunities to buy assets at a discounted price. So understand the different things that are happening right now. That way you can be prepared, you can be financially educated, because it's your duty to take care of yourself, your family, and your community, and it all starts with building that education in your mind. If you are in your 30s and you want to figure out how you can start investing, it is not too late, but you need to get started ASAP, because there are 3 factors that will determine how wealthy you will become. Number 1 is how much money you invest. Number 2 is the return that you get on your money. And number 3 is the time, meaning how long that you can invest your money for. So for example,